Hello traders, Gary Wagner here. It is Friday finally. Happy Aloha Friday as we say on the islands. It is the 8th day of October 2021 and this is the Daily Report for Gold and Silver, our weekend review, and what a way to end the week. We had the jobs numbers come out today and they were actually below the previous month. However, the reaction to the tepid numbers were completely different than we have seen in the past. The opening letter will attempt to detail why that is, and during the chart section, we'll be more specific about that. An extremely interesting day, and most importantly, reaction to the release of September's Labor Department's jobs report. While it showed a decrease in the number of new jobs added and came in well below expectation, the short rally that began immediately following the release of this report was short-lived, and gold actually closed down by $2, currently fixed at $1,757.20. We explain in detail some of the components that took gold lower today in our opening letter. In fact, dollar weakness actually tempered the decline in gold because the dollar itself was off by about 0.1%, currently fixed at 92.12. An interesting aspect to today's changes in the dollar and gold is they both closed down by the exact same percentage drawdown, 0.11%. The first chart we're going to look at during today's show is an extremely short-term 15-minute candlestick chart. This first arrow represents the beginning of the 8th Friday, and of course it is in Hawaiian time, which simply means that at 2 o'clock a.m. in Hawaii represents 8 o'clock a.m. in New York or Eastern Daylight Time. The jobs report was released at 8:30 this morning in New York, and that would be this particular candle right here. So what we can see is that immediately upon the release of the report, we had gold trading at approximately 1761. Within a 15-minute period of time, we saw it run from those lows all the way up to the highs of 1778 before closing a little bit lower during that session at approximately 1776. Then in the next 45 minutes, it would trade to the high today, which occurred at 1782. That would be these three candles here. But as quickly as gold ascended to stronger pricing, it declines. It was not able to sustain today's early gains. You can see the major decline occurring over 5 candlesticks, which represents an hour and 15 minutes. And then for the rest of the session, in essence, traded sideways, had one small gap up, rounded bottom, closed a little bit lower, finally settling at 752.20, which is very, very close to the open of the day. The question is, why did a weak jobs report have initial gains and then give them all back in the period of maybe 3 to 4 hours? We covered that in detail in our opening letter. But as I said, the devil is in the details. We are looking at a daily candlestick chart of gold futures. We have a Fibonacci retracement as well as 2 moving averages, a shorter term 21-day exponential moving average, and a simple 50-day moving average. We'll go ahead and enlarge this a bit because what I find most interesting is that the high of the day occurred precisely at the 50-day moving average. This is the dashed green line here. 1781.40 is that actual number. The actual high today was 82 and change. So we're talking about under $1 differential between the two. The other interesting thing is the other level of resistance occurs at the 61.8% fib retracement, which is at 1767. And that also lines up directly with the 21-day exponential moving average. And as we have talked about, both the exponential as well as the simple have really given us a clear indication of former resistance. The only change that I've just made to the chart we've been looking at is I converted the exponential 21-day moving average to a simple moving average, because that is where we get a clear indication of how powerful that price point was. If we take a look at the most recent highs occurring in the market earlier this week, we touched upon the high but not through it on Monday. On Tuesday, it opened at the high and traded lower. This is Wednesday, Thursday, and then Friday. So while we did see a higher high than the entire week, we had a close that was below all of the closes this week, with the exception of Monday. I've added a horizontal line to mark today's close, and as you can see, it matches up to Monday's open and closing price, which is why when we convert the daily into a weekly chart, we do get a doji candle, meaning the open of Monday and the close on Friday were fairly close or identical. This last chart is a daily candlestick chart, but with the addition of the moving averages and retracement areas, we have added a Elliott wave count, because that will give us some concept or clue as to where this market could go in the near future. And as I believe, it is predicting lower pricing. Now, on a bear count, and most people are used to a bull count, and a bull count would be a wave 1, 2, 3, 4, 5, followed by a ABC of sorts. You get the exact opposite. So in a bear count, you would get something like a 1, a 2, a 3, a 4th, and then our 5th, which has not only repeated that count once, but is now on the third 1 through 5 count, and we are currently in the third of 5 bearish waves. The final chart that we are going to look at is a daily chart with an Elliott wave count. I've said on many occasions that Elliott wave theory is an art as well as a science, and this is using a much longer time sequence to really simplify the count. We are only showing our major waves. When we do this, as you can see, this is the conclusion of that third wave. We've completed a 4th wave. We are currently in a 5th wave, which is a wave taking the market lower, and this model predicts gold going as low as $1,600 per ounce. This has been Gary Wagner wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.